Index funds are investment funds built to copy a specific market index. Instead of trying to pick winning stocks, they aim to mirror the performance of a benchmark like the S&P 500 or the Nasdaq. The idea became popular in the 1970s when John Bogle introduced the first retail index fund, arguing that most active managers fail to beat the market over time. An index fund simply buys the same stocks that are in the index, in the same proportions. Because there is no team constantly researching or trading, costs are usually low. That low cost is one of the main reasons they matter. Over decades, small differences in fees can have a large impact on returns. Index funds are generally passive, transparent, and predictable. Investors know what they are holding and what they are tracking. They are often used for long-term retirement accounts because they provide broad diversification with minimal effort. Rather than trying to outperform the market, they focus on matching it as closely as possible. Mutual funds are pooled investment vehicles where many investors combine their money, and a professional manager decides how to invest it. These funds existed long before index funds and were designed to give everyday people access to diversified portfolios. A mutual fund might focus on large companies, small companies, bonds, international markets, or a mix of assets. The manager actively researches companies and makes buy or sell decisions based on a specific strategy. Unlike index funds, most traditional mutual funds are actively managed. That means higher operating costs, which are passed on to investors through expense ratios and sometimes sales fees. Shares of a mutual fund are bought or sold at the end of the trading day at a price called the net asset value. Investors cannot trade them throughout the day like stocks. Mutual funds matter because they offer professional management and diversification in a simple package. For many decades, they were the primary way individuals invested in the stock market through retirement plans and brokerage accounts. Hedge funds are private investment partnerships designed for wealthy individuals and institutions. They are structured differently from mutual funds and operate with far fewer regulations. The term hedge originally referred to strategies meant to reduce risk, but over time hedge funds have evolved into vehicles that often take on significant risk in pursuit of higher returns. They can invest in stocks, bonds, derivatives, currencies, real estate, and even complex strategies like short selling or leverage trading. Access is usually limited to accredited investors who meet certain income or net worth requirements. Hedge funds often charge higher fees, commonly a management fee plus a percentage of profits. This structure is sometimes called 2 and 20. Managers have broad flexibility in how they invest, which can lead to creative strategies but also large losses if bets go wrong. Hedge funds matter because they influence global markets and manage large pools of capital. However, they are not designed for average retail investors, and their performance varies widely depending on the manager's skill and strategy. Exchange-traded funds, or ETFs, combine features of both mutual funds and stocks. Like mutual funds, they pool money from many investors and hold a basket of assets. Like stocks, they trade on an exchange throughout the day. ETFs were introduced in the early 1990s as a way to provide diversification with more flexibility. Many ETFs track indexes, similar to index funds, but some are actively managed. Because they trade in real time, their price can fluctuate during the day based on supply and demand. Investors can buy or sell shares at market prices whenever the exchange is open. ETFs often have lower expense ratios compared to traditional mutual funds, partly due to their structure. They also tend to be more tax efficient in certain jurisdictions because of how shares are created and redeemed. ETFs matter because they offer convenience, diversification, and cost efficiency in one product. They have grown rapidly in popularity, especially among individual investors who want flexibility and transparency. Actively managed funds are investment funds where a manager or team makes deliberate decisions about what to buy and sell. This category includes many mutual funds and some ETFs. The goal is usually to outperform a benchmark index rather than simply match it. Managers analyze company earnings, economic trends, and market conditions to identify opportunities. Some focus on growth companies, others on undervalued stocks, and some on specific sectors or regions. Because active management requires research, staff, and frequent trading, costs are typically higher. The debate around active management has continued for decades. While some managers do outperform in certain periods, many struggle to consistently beat broad market indexes over the long term after fees. Actively managed funds matter because they offer the possibility of tailored strategies and potential outperformance. At the same time, they require investors to evaluate track records, fees, and risk levels carefully. Passive funds are designed to follow a predefined index or rule without frequent decision-making by a manager. Index funds and many ETFs fall into this category. The philosophy behind passive investing is that markets are generally efficient, and trying to consistently outsmart them is difficult and costly. Instead of searching for undervalued stocks, passive funds replicate the holdings of an index automatically. This approach reduces trading activity and keeps costs low. Passive funds gained momentum after research showed that many active managers underperform their benchmarks over long periods. Investors appreciate passive funds for their simplicity and transparency. There is no guessing about which stocks the manager might choose next. Passive funds matter because they have changed the investment landscape, shifting trillions of dollars into low-cost products that aim to capture overall market growth rather than chase individual winners. Open-end funds are investment funds that continuously issue and redeem shares. Most mutual funds operate under this structure. When new investors add money, the fund creates new shares. When investors withdraw, shares are redeemed, and assets may be sold to meet those redemptions. The price is calculated once per day based on the total value of the fund's holdings divided by the number of shares outstanding. Because pricing happens at the end of the day, investors do not know the exact price at which they will transact until markets close. Open-end funds matter because they are one of the most common structures for retail investing. They allow flexibility in adding or withdrawing money while maintaining a diversified portfolio managed under a defined strategy.